Breaking news. Well, it's not breaking news because it's all anyone is talking about up and down my social media feed. The Fed just dropped rates by 0.5%. Now, what does that actually mean for you and your mortgage? Is it time to refinance? Well, don't worry. I've got you covered. In this video, I'm going to talk about what the rate cut actually means, how refinances work, how you can decide whether it makes sense for you to refinance, and share a little bit more about Streamline Refinancing. I'm Shakila LeBlanc, aka the Loan Slayer, and I'm here to help you say hello to your new home. So, yes, the Fed just cut interest rates by 0.5% for the first time in over 4 years. But before you get too excited about mortgage rates dropping overnight, here's the real scoop. Lenders have already priced this rate cut into mortgages weeks ago. See, when the Fed talks about the need for a rate cut, the market starts to adjust immediately. Investors anticipate the move. So by the time the Fed actually makes the cut, mortgage rates have already been trending down. In fact, mortgage rates have been improving for the past month or so, hitting some of their lowest levels of the year. You're not going to see an immediate 0.5% drop in mortgage rates today or tomorrow, but this is still great news for anyone looking to buy or refinance because today's rates are so much better than where they were a year ago, and they may even improve in the near future. So while the Fed's cut is important, keep in mind that mortgage rates don't move in exact sync with Fed rates. If you're hearing or seeing others announce the Fed cut rates, buy now, do this. Listen, it's a marketing tactic, especially if there's no explanation or education. They want you to call them and text them. I want you to call and text me. But the most important thing, and with all seriousness, what to remember is that rates have already adjusted. They can move slightly up and down on a daily basis, but they have not dropped 0.5% since yesterday's announcement. Now that we've gotten that out of the way, let's jump into refinancing. Refinancing is basically like hitting the reset button on your current mortgage. Instead of sticking with the loan you got a few years ago or a few months ago, you're taking advantage of these shiny new lower rates. You're swapping out your old mortgage for a new one. Same house, but hopefully a better loan with better terms and a lower monthly payment. So let's talk about at what point does it make sense to refinance and what things should you consider? You should think about refinancing when it provides a substantial benefit and or more favorable terms. Here are some common examples of why you may refi. Number 1, lower interest rate. The golden rule is if you can lower your interest rate by at least 1% or more, it's probably worth looking into. Number 2, if you need to switch from an adjustable rate mortgage to a new permanent fixed rate mortgage. Number 3, if you are currently in a rate buy down program and your permanent rate is at least 1% higher than current rates, then you can look into refinancing. So everyone that was in that like 2-1, 3-2-1 buy down, that's for you. Number 4, if you need cash, if you want to cash out some of your equity for something like renovations or, of course, paying off high interest debt. Now, while all of these are great reasons to refinance, here are the things I want you to consider. Number 1, second mortgages and DPA programs. If you close with a DPA program, you need to understand the terms. Do you have to pay back the loan if you refi? In most cases, you do if you don't hold on to the mortgage for a certain amount of years. If you have to pay this lump sum of money back, do you have enough equity to pay it back within your refinance? Do you have enough funds if you don't have enough equity to pay that off? You may even get a lower rate, but if you had a second loan, your loan amount is going to be higher because you have to include that in the refinance. Number two, if you did a buy down on your initial loan, have you been in the home long enough to recoup those costs? For example, if your buy down cost you $2,000 and saved you $50 a month at the time, you would have need to stay in the home or keep that loan for at least 40 months, which is a little over 3 years to break even. Now, hopefully you had this conversation when you initially purchased your home, but it's something that I just want to point out so that you can consider and think about. Number three, closing costs. Just like when you bought your first home or close on your home, you're going to have closing costs when you refinance. These are going to include the exact same things: lender fees, title fees, credit reports, possibly an appraisal. And depending on the loan type that you are refinancing into, sometimes this can be rolled into the loan amount. But just like in the previous example, you need to consider your break even date. And do you plan to be in the home for long enough to recoup those costs? So if you are saving $200 a month by refinancing, your closing costs are about $5,500. You would divide 5,500 by 200, which gives you a break even point of 27 and a half months, which is a little over 2 years. That's not bad at all. But if you're planning to sell in the next 12 months, that just would not make sense financially. Number four, escrows. When you refi with a brand new lender, you also have to establish a new escrow account. Now, you will be refunded from your current lender once their loan is paid off. But I wanted to bring this up because if you are refinancing close to when your taxes and insurance are due, your cash to close may be on the higher side. But remember, you will get those funds back from your old lender once it's paid off. Number five, loan terms. You do not always have to refi into a 30-year mortgage. If you can afford it, you can switch to a 15, 20, or 25-year term instead. Now, for my FHA and VA loan holders out there, let me put you on game with something called a Streamline Refinance. It's like refinancing, but on easy mode. For FHA loans, you can streamline your refi if you're just lowering your monthly payment or switching from an ARM to a fixed rate mortgage. For VA loans, it's called EARL, which stands for Interest Rate Reduction Refinance Loan. But we like to just call it EARL because, let's be honest, who is going to keep saying all of that? Now, the general rules of streamline refinancing are below. Let's see. One, you must be current on your mortgage, and it must be at least 210 days from the first payment due date, which means you have to at least have made 6 payments. Number two, you must have an existing FHA or VA loan. Number three, you cannot pull out cash. And number four, the refinance must provide a net tangible benefit like lowering your monthly payment, lowering your rate, etc. A streamlined refi is exactly what it sounds like. Streamlined. It's very easy, very simple, very demure. And it's quick. You don't need a full appraisal. You don't need to verify your income again. And in some cases, you don't even need a credit check. Now, the one caveat that I will say is for FHA Streamline loans, the closing costs cannot be financed into the loan. So the out-of-pocket expense can be a bit higher, especially with the escrows that I was talking about earlier. But if timed right and with a resourceful loan officer, you may be able to get it done for about the same amount as your normal mortgage payment or two. And of course, you get to skip a payment for that next month before you begin making payments on the new loan. So is now a good time to refinance? Well, with rates being at its lowest in over a year, now could be a great opportunity for a lot of homeowners to lock in a better rate and save some serious money every single month. But remember, it's not a one size fits all situation. Talk to a mortgage professional to see if refinancing makes sense for your specific situation. If you have any questions at all, feel free to drop them in the comments below. And if you found this video helpful at all, please hit that like button and subscribe to the channel for more mortgage tips and home buying advice. See you in the next video.